We've talked about this idea of comparative advantage and how trade can create greater efficiencies, but the story is actually a little bit more complex than that. And so I think I'd like to introduce a new sort of model of trade to think about some of the patterns that we see in global trade and why things might not be quite as efficient as we might expect. So Ricardo's model, the idea of comparative advantage, makes assumptions that don't necessarily hold up, right? And so we can ask questions like, why would Portugal be able to make cloth cheaper than England, given that both both countries have hills, and grass and sheep, and can in theory have the same inputs. And maybe you could tell a story about skills or technology, but skills and technology don't really fit neatly into Ricardo's model, and we don't necessarily know what that would mean, that there's differences in terms of skills and technology. And so Heckescher and Ohlin offer a revised version of Ricardo's analysis and say, when we talk about the absolute and relative comparative advantages of states, we should really be thinking about how states have different mixes of labor, L, I guess, is how we abbreviate that, and capital. Again, we abbreviate that K because of German and Das Kapital, the book by Marx. And we can think about individual goods being produced by a mix of these two inputs, and countries having different distributions of those inputs, right? And so winemaking is really labor intensive because you have to pick grapes and you have to be delicate about that. So you need your hands to do that. And then I guess stomping grapes is done with feet. And again, that's labor intensive. Whereas cloth production, sure, you shear the sheep, but the real work comes in the creating of the cloth and the spinning of the wool into thread, and all of that can be done through mechanization, right? Looms. And so in order to produce cloth, you need a lot of capital, and in order to produce wine, you need a lot of labor. And so that might be an explanation for why Portugal does so much better in producing wine as opposed to cloth, right? So we could think about it that way. But once we start down that road of thinking about countries in terms of having capital and having labor and maybe having different advantages in terms of what they produce, several implications start playing out, right? So if you are in a country that is capital intensive, you got lots of cash and lots of machines, then you're probably going to find the best gains in trading with countries that are capital poor, because you're going to get that kind of specialization where one country can produce something really efficiently because they have the right mix of what you need for it, and another country can produce something else really efficiently because they have the right mix of what you need to do that. And so trading with different types of countries, capital rich versus capital poor, is going to produce these kind of outcomes. I should point out that when I was in China a number of years ago, I had my son with me, and as we were wandering around, we were pointing out different things that happen differently when you're in a capital-rich country versus a capital-poor country and a labor-rich country. And so in the United States, street sweepers are these big hulking machines that run down the streets almost as fast as cars. Where in China, a lot of street sweeping is done with people with brooms, right? Because brooms are cheap, and the cost of labor and hiring somebody to sweep a street is relatively inexpensive, and that's available because of labor abundance. And so it distorts all different aspects of your economy, and how you do different things is going to be very different. And that's where you're going to see the biggest gains in terms of economic efficiency. Another implication of the Heckescher-Ohlin sort of model is that if you're a worker in a capital-rich state, there's not a lot of demand for your labor, because the kind of things that are being produced are not the kind of things that require a lot of workers, right? The things that are going to be produced are capital intensive. They have lots of machines attached to them, but not necessarily labor intensive. And then the flip side of that is, if you're a capitalist, if you have lots of cash on hand and you're in a labor-rich state, but a capital-poor state, as you look around for different investment opportunities, you're going to find that there's not a lot of people who are building machines and deploying machines, that a lot of your production, a lot of your advantages in production come from not buying machines, but instead from employing people. And so you're not going to be investing in industrialization in poor countries in quite the same way. So we can think about how well the Heckescher-Ohlin model does in terms of explaining the patterns that we see economically and globally. And I think implication one is pretty clearly not supported, in that most of the trade that we see in the world goes between countries with similar levels of economic development. And I've actually got a map I'll show you for this. This is who the United States trades with And you can see that there's a whole lot of trade going back and forth between the United States and China. And that would fit with the Heckscher-Ohlin model, right? China is very labor rich and less capital rich, and the United States is very capital rich and less labor rich. And so we should see that kind of trade. But globally, when you look at who the United States trades with, the US trades as much with Mexico and Canada as they do with China. The United States trades considerably with Japan and with Europe. And those trading patterns collectively add up to much more of the bulk of US trade, both imports and exports, than what's happening with China. So clearly something else is going on rather than just finding the efficient ways to trade. A second implication of the Heckscher-Ohlin model is that workers in capital-rich states are going to really struggle to find jobs, to sell their labor. And I think that this is really supported. If you think about what it takes in the United States to really find a good job, there's a lot of investment in your own skills, right? People go to school and they learn to computer program, or they learn to do specific things or get different licensing and certification, because what you're essentially trying to do is you're essentially trying to invest in yourself enough that you can outcompete a machine. That there's lots of things that can just be automated, and there's the money to buy the machines to automate them. And if you're going to convince a business that you should be employed, you have to convince them that you have skills that go above and beyond what can just be purchased through a machine. And then finally, when we think about the effect of capital in poor countries, this is also supported. As we noted back when we were talking about development theories and the financing gap, there's a huge pattern where money in poor countries gets pulled out of poor countries rather than being invested in poor countries and gets moved into the capital markets, the stocks and bonds markets in the United States, other industrialized countries, because that's where the big return on investment tends to be, even though there's all these opportunities where you should be able to just throw cash into building factories in developing countries and see growth. So the Heckscher-Ohlin model seems to work well as sort of a theory. It seems to work well sort of anecdotally. We see these differences between capital-rich and capital-poor countries, but the implications don't play out quite as well as we might expect, particularly with trade. And it seems that something else is going on with trade patterns. And so we can try to talk about what that other thing going on with trade patterns is, and why we see so much trade between rich countries when it would make more sense to trade with poor countries. And there's explanations that have been offered by economists and explanations that have been offered by political scientists. And so for the economists, it might be a function of shipping costs and geography, right? If you have to ship things around the world, maybe that raises the price, and so you trade with people who are close by because you can reduce those costs. Maybe that accounts for it. Then there's also the Linder hypothesis, and this is an idea that you trade with states that are at a similar economic level because you have a similar expectation for quality of goods. And I think maybe one way I can maybe illustrate this is, again, between the United States and China. When I'm in China, I'm always frustrated by the Kleenexes, that they're just paper tissue thin, or even napkins are just like little tiny squares, and it just drives me bonkers because I want the triple ply lotion infused high quality technology quilted Kleenexes that hold up really well, and I can't get those in China. And so the thinking is that we have different expectations for the quality of our goods based on different standards of living, and therefore if you're a company in China and you're thinking about manufacturing Kleenexes, you're not thinking in terms of what an American market wants out of a Kleenex. You're thinking in terms of your experience in the Chinese market. And that might explain why we see rich countries trading with rich countries, even though economically it'd be more efficient to trade with poor countries. Maybe. Political scientists would sort of flip this around and say, no, it's international political economy. All of these things are political decisions that were made by states, right? And so maybe it's a function of the domestic politics, right? That if you are trying to sell trade agreements to your domestic political audience, and you go to a factory and say, we're going to set up a trade agreement, when workers hear we're going to set up a trade agreement with Britain or with France, they say, you know, we can compete with workers in Britain and France. And they shrug and say, okay, maybe that makes sense. But when you go and say we're going to set up a trade agreement with China or Mexico or a developing country, workers in rich countries correctly recognize that workers in poor countries are going to work for a lot less, and that's going to undercut labor in wealthy countries. And so you get political pushback against trade agreements that include developing countries in rich countries. And that's one of the reasons why it's easier to facilitate trade agreements with European countries versus the United States than the United States and, let's say, um, you know, China or another developing country. We can also think about it in terms of international politics. It's not just the domestic piece that's setting this policy, but it's also the international piece. And that when we decide to set up a trade agreement, that's a political decision. It's not a decision that's made for economic efficiency. It's a decision that says, I want to tie my economy to your economy. I want to entrench this partnership. And so you set up economic relationships with states that you have political alignment with. And so part of why we see trade between the United States and Canada and the United States and Mexico is part of an effort to sort of stabilize those relationships. Part of why we see trade relationships with the European Union and with Japan and South Korea is because those are strong security relationships that the United States has. And so trade agreements follow the political agreements, and those oftentimes don't reflect what's economically efficient, but what makes sense in terms of who's a good ally for the United States.